Okay, so tonight, again, we're doing chapters 19 and 20 tonight. We're going to talk about real estate taxation. When I mention those words, taxation, what comes to mind?
Property taxes?
Property taxes, government taxes, taxes in general, the taxes you might have to pay if you sold a property, capital gains taxes. What else do you think about in terms of taxes? We talked about the subsidies, the tax programs that they're putting out there to try to get companies to come in. That's all part of taxation, part of this process. This chapter is very condensed. I am not an accountant. And there are so many things that go on in the accounting world where this really strongly applies. This is just a big, 30,000-foot view of taxation. Very generalistic kind of stuff. Minimal amount of stuff, and we're going to get through the chapter pretty quick because it's minimal amount of stuff that you need to understand about taxation. The biggest piece of taxation, things you need to understand, laws have changed. I remember when I was younger and started out in this business, if you sold your property, your residence, and you weren't 55 or older, you had to pay capital gains. Today, you don't have to pay capital gains tax if you lived in it 2 years or longer. So that whole thing about people were holding properties or worried about selling, and then before that whole process, there was the lifetime exclusion. You could only do it one time, your residence one time. So people that were older were afraid to sell their houses into retirement, or, okay, we're retiring, but we're not going to buy anything else. We're moving on to the next phase of life. We're not going to buy anything else, and we'll take our one-time exclusion now. And so this whole ball kept rolling about, well, when's the best time to sell my piece of real estate to avoid capital gains tax? Because capital gains tax today is, well, it's 18, 28%, somewhere in the range, depending on what you're doing. But as much as 1/3, basically, of the profit could be eaten by taxes. So a lot of people thought twice about doing all that. So tax laws change. Things change constantly. And the best way to do all this is make sure you have a good tax accountant working on your stuff. Okay, so what we're going to talk about, the difference between tax deductions and tax credits. Why is a tax credit so much better than a tax deduction?
Because it's transferable?
No, because tax credits apply to the overall amount of tax, the 20 to 35% credit of overall amount of tax, whereas your deduction is just the top piece, and you still have to pay your other tax. So basically, tax credits can far outweigh tax deductions in terms of money. That's the quickest, easiest way to think of it. We're going to talk about the limitations on deducting mortgage interest. Oh boy, tax laws are getting ready to change. Our mortgage interest, the whole reason we were buying houses for forever was we had mortgage interest. We had the mortgage that we could deduct. They're starting to change that whole thing going forward with how you file taxes. What are the amount of exemptions and stuff that you can claim. Explain how gain on sale of a residence is taxed. Understand concept of 1031. We call them like-kind exchanges. And recognize how real property taxes are calculated. So what are the two things you do in life? You die and you pay taxes. Okay, so no matter what happens, you're going to pay taxes. And we're going to learn a little bit, again, just the 30,000-foot view of taxes here. So tax deductions versus tax credits. Basically, a deduction reduces your taxable income. It's the piece right off the top. But a tax credit will actually lower your tax bill. So it's always better, if you're talking more money, a greater amount of money, to try to get the tax credit. Mortgage interest deduction. The homeowner can deduct his mortgage interest from his or her personal tax returns up to the property's fair market value with some limitations. Okay, up to the property's fair market value. Which means you could do an interest-only loan, basically, on the value of the property and be able to deduct that. The other things that happen, though, is we have Heloc Loans, home equity loans. You can take out a home equity loan against your property. You get to claim that as real estate tax deduction, but you could be using that to pay for a car, for a vacation, pay your credit cards down, whatever, but you're still allowed to use that because it's a home equity line of credit. You're still allowed to use that as a tax deduction on your taxes. Home equity interest, again, taxpayer may deduct the interest from a home equity debt of $100,000 or less. So again, we're talking more middle income here, and lower is what we're looking at for these kind of numbers and where this works. The wealthier have other things that they're doing to avoid taxes. Deductions for points. If you pay points on a closing, points are prepaid interest or extra profit charged when a lender charges the borrower for securing a loan. These are deductible as income taxes. The first year that you pay points to buy a house or finance the house, you can deduct those points on your taxes. You want to be able to use your residence for business purposes. Boy, a lot of people are getting ready or doing this now. But there's rules about how you do that. And if you read the textbook, the guy who writes the textbook, one of the writers, he says that they've used their house a lot to write the textbook. It's their home office, but they also use it for other purposes. Therefore, they can't deduct the taxes on it. It's not truly a home office. My boss works from one of her bedrooms now. She moved to Dallas. The company doesn't give her an office to go to. She works from a bedroom in her house. She is absolutely keeping track of that pro rata share of her house to deduct it with the house that she bought to be able to work and do business down there. My assistant's getting ready to move at the end of the year. She's going to move to Alabama, so I'm not going to see her face-to-face anymore. We'll be a long-distance relationship, but when she goes there, she'll be working from her house full-time. She's got 2 small girls. She'll be able to get them off to school, go to her, stay in her office, work from her house, see them home from school, work from her house again. It's a back-and-forth balancing act, but I guarantee you, she's an accountant, part-time, so she'll keep track of that deduction.